All right, there we go. So, hello. Welcome. It is January the 20th, and we are dealing with taxes and restrictions on foreign buyers and sellers, because really you can't deal with just the new prohibitions. There are other laws, and generally when you're dealing with foreign buyers, you need to understand the trifecta, which we'll talk about today. Some administrative stuff. As always, our lectures are public, our forum is private. I'd encourage everyone to invite as many people who are registered professionals as possible to our forum. Strength, numbers make us stronger, and encourage us to keep going with things like this. All right, so I'm expecting a slightly lesser crowd today just because this is a highly technical subject and it doesn't involve a lot of people's daily practice, though you come across foreign buyers in your career all the time, and you do need to know these things. So let's start talking about it. And let's, without further ado, it's 10:04. I'm going to kind of switch into high gear and get going. Anyone who wants, I have the chat open at the same time and we can go forward. And the only thing I need to figure out before we start is how do I make it a full page? Let's see, enter full screen. There we go. There we are. Can everyone just see my screen? Can everyone see my screen? I'm not sure if you can. Someone just respond and let me know. Can you see my screen, guys?
Yes, we can see it.
All right, fine. All right, a little quip. This sounds really dry. Is it dry? Yep, like kindling. Will it make me cool? Will it at least up my Tinder game? Jesus, man, this is a Wendy's. I've wanted to use an expression, Jesus, man, this is a Wendy's for some time. Finally got around to it, so go me. All right, let's get going. Why is this? Sorry. All right, so we're going to start with the most recent piece of legislation, which is the federal enactment of the prohibition on purchase. So to be clear, and this is a bit, we're going to really kind of go high level for a second. The way things work is that property and civil rights in the province or property and civil rights are governed by the province under section 9216 of the Constitution. And thus, it is almost always the case that the province makes laws vis-a-vis real estate. And yet, the federal government is entitled to make laws concerning things of federal jurisdiction. And banking is one such thing, and also foreign investments are another such thing, and I could go into it. It's all contained in section 91 of the Constitution. Under section 91, the federal government saw fit to interject itself into provincial matters that are typically of provincial jurisdiction. And they passed a piece of legislation which we now must adhere to, called the Prohibition on the Purchase of Residential Property by Non-Canadians Act. Now, just a little bit of high-level politics before we delve into this. This is a typical example of the federal government involving itself, or as the government involving itself at exactly the wrong time. Because, of course, when this was devised, there was a mad scramble to stop investment because real estate was going up 3% per month. And by the time this was actually implemented, we were all desperate for foreign money or anything that could keep our markets somewhat propped up. And as a result, what we're looking at is a law that was devised in the heat of 2021 January, but came into effect in the heat of January 2023, a very different time. And I don't need to explain that to you. Governments are terrible. They take forever to make decisions. And this is one of the reasons we all roll our eyes. But having said that, the law is now in effect. And as a result, there are now, this is still a very high level before we go into this particular piece of legislation. There are now 3 pieces of legislation that you must concern yourself with if you're dealing with foreign owners. We're going to talk about all of them. The first is the PPRP, the Prohibition on the Purchase of Residential Property by Non-Canadians. The second is the NRST, the non-residential speculation tax. We'll talk about that and the changes that have taken place. And the third is withholding tax, what happens when you sell property. We'll talk about that as well. If you understand all 3 pieces of legislation, then you understand the permutations of what a foreign buyer needs to concern itself with when dealing with property. So without further ado, let's get our hands dirty. So the prohibition on the purchase of residential property by non-Canadians came into force on January 1st. The act prohibits non-Canadians from purchasing residential property for a period of 2 years with some exceptions. And you'll note that on my screen, I put 1, 2, 3, 4. In order to understand the prohibition on the purchase of residential property by non-Canadians, you need to understand these 4 points. You need to understand what a non-Canadian is. You need to understand what the definition of purchase is. You need to understand what a residential property is, and you need to understand what the exceptions are. And if you do, and if you understand all those things, you'll understand the act. And the act isn't very complicated. So without further ado, let's turn our attention to it. So first, the act prohibits non-Canadians. What's a non-Canadian? Well, a Canadian is defined by citizenship. This is different, by the way, than the definition that you're going to see we have for section 116 withholding tax, which is a definition that extends to tax citizenship. I'm going to pause for a second. There's 2 different types of citizenships that exist in Canada. The first is the citizenship that we all have when we contain a passport. It's the one we all fight for, that we go through immigration for and everything else. When you say you're a Canadian citizen, it means you've gone through a process. And if you go away for 20 years, you remain a Canadian citizen. Your passport remains valid. This is different than a Canadian citizen for tax purposes, meaning someone who sojourns in Canada, spending over 183 days here, and pays taxes regularly. That is the definition of residency for tax purposes. The PPRP and the NRST define citizenship and PR status as actual citizenship. It has nothing to do with your tax circumstance. So, what is a Canadian? A Canadian is a Canadian citizen or a permanent resident or a registered Indian under the Indian Act. I don't know why we still call it the Indian Act, but we do. So that's a very simple definition. If someone has a passport, if someone has a PR card valid, boom, they are allowed to purchase. Easy peasy. What about corporations? Well, if the corporation has been incorporated under the laws of Canada or a provincial jurisdiction, you're good, unless there is a controlling interest to the Canadian corporation of over 3%, which is a non-resident. So if the Emir of Dubai owns 50% of a corporation that was incorporated in Canada, then no, that corporation will not be treated as residents of Canada. It's interesting that they actually picked 3% shares. It's very interesting, actually, because in the tax code, the least I've ever seen for affiliate is 10%. And usually it's a controlling interest being 50%. But in this instance, the PPRP said if 3% of the voting rights of a corporation are owned by a non-resident, then the corporation itself is non-resident. Why did they do that? I have no idea, but that's what the law is. All right, so we understand what a Canadian is. A Canadian is someone who has a citizenship, is PR, or alternatively is a corporation incorporated in Canada or a Canadian jurisdiction, which is not controlled, meaning that over 90%, 97% of the shares are owned by Canadians. Simple, easy, done. Any questions on that before I move on?
Can I ask a question?
Yeah, of course.
Hi. So good morning and thanks for your presentation. So I just wonder, in the act, it says 3% of entity and to the value of equity and 3% of voting rights. Is it equal to shares? I mean, if they wanted to say 3% of shares, why they didn't directly say that it's 3% of the shares? That's my question.
That's a good question. That has more to do with corporate law, and it also has to do with the fact that there are different classes of shares in a corporation. It's a bit beyond our purview here, but if you think about it, there's Class A, Class B, preferential shares. There's all sorts of shares. The shares that matter are the controlling shares. And as a result, they can't just say shares, because what do those shares refer to? Which class of shares or anything else? So what they care about are the voting shares. Does that make sense?
Yeah. Thank you. Thank you so much.
Okay. All right. So we've defined what a Canadian is. Now let's define what a purchase is, because again, all I need to do is explain this one sentence and you understand the PPRP. The Prohibition on the Purchase of Residential Property by Non-Canadians Act came into force. The Act prohibits Canadians, we've already talked about it, from purchasing residential property for a period of 2 years with some exceptions. Okay, let's talk about purchase. A purchase is defined as a legal or an equitable interest in a real right in residential property. Let me stop. The amount of questions I've gotten every single day since this act has come into force about whether or not my uncle, who is a Canadian citizen, can buy and hold this for someone else is astounding. The answer is no, you cannot. There are two types of ownership that the law recognizes, that a court will recognize. The first is a legal ownership. Legal ownership is when you put your name on title. And the second is a beneficial ownership. It's when someone else puts their name on title, but you effectively own the asset through a bare trust or anything else. So, you know, when someone goes on for the purposes of mortgage qualification and they put their name on a title, even if they're on for 1%, they don't actually own that 1%. They're just putting their name on so that you qualify for a mortgage. That 1% is actually being held in trust for you in most instances. You cannot get around this law by having a Canadian put their name on title, holding it in trust for an equitable interest for someone else. Does that make sense? I assume it does. You guys are real estate agents, you understand that. Okay. So a purchase is defined as a legal or an equitable interest in a residential property, but it does not include, I'm going to start with B and then we're going to get to A in a minute, a rental transaction. So you can go ahead and rent to a non-Canadian, no problem. The transfer under the terms of a trust that was created prior to coming into force. Trusts usually last for 21 years. And you can transfer, a lot of trusts have the ability to take these assets that are as part of the trust and transfer them over to other parties. Well, if the trust was formulated before this law came into effect, you can still do that. D is an important one, the exercise of security interest. So if you think about it, if a power of sale is engaged in, or more importantly, a foreclosure process such that the lender ends up owning the property and taking it over, well, at that point, if that happens, I'm sorry, I have a dog that's about to bark. 1 second, please, guys. Whoever's marking up, I'm not sure how you're doing it actually, but I'd appreciate it if you would not mark up the session. This red line is not me. All right. So if a lender is coming in and exercising their foreclosure rights and stepping into the shoes of the owner, then they can be a non-resident as well. And then there's part A, and part A has actually led me to a bunch of questions that no one really knows the answer to. And what it says is the acquisition by an individual of an interest or a real right resulting from death, divorce, separation, or a gift. Okay, we understand what death is if you're left it in the will. We understand what divorce is, okay, if you're married and you get it by way of a separation agreement. Gift. This seems like a glaring loophole to get around the law. Because if, for instance, you are a non-resident who want to buy a property, you can get a Canadian resident to buy the property and then simply gift it to you. Now, that's assuming there's no mortgage on the property because you can't do that without a whole bunch of consequence with the bank. But it does seem like a glaring hole. I have no idea how they're going to define it. There has been no case law on the subject. I do not understand what it is that they are intending through the word gift, and I have been unable to find anything else. So anyone who has a question as to whether you can get around this by simply putting this in a Canadian's hand and then gifting it, it does appear to be the case that you can do that, but I have no understanding as to whether or not there will be a prohibition or these regulations will be tightened up, which PS, I suspect they will if the government cares about this legislation at all over the coming course of the years. Yes, Carmen.
Yes, just a quick question. With gifting it, is there any limitation as to, legally, meaning if you're not related to the individual, if you have no business with this individual, could it not be considered some sort of laundering?
No, it wouldn't be considered laundering. You can gift any amount and you can gift it, period. As long as it's truly a gift, like no money being transferred, you can do it. That doesn't absolve you, by the way, of tax consequence. There's something called, this is a bit off track, but there's something called the imputed tax rules, meaning that if someone does sell a property or gift a property, even though they've paid $0 for it, it will be imputed to be fair market value, meaning that you'll still have to pay the capital gains on that, though you'll avoid land transfer tax. So it's not really a way of transferring property that many people avail themselves of. I'm just saying it's a glaring loophole based on the way the law has been written. Does that make sense? And no, it's not a laundering issue.
Yes.
I mean, it could be used for laundering, but not on its face. Okay, so we've now defined what a non-Canadian is. We've now defined what a purchase is. On to a residential property. So what's a residential property? Well, a residential property is a detached house or similar building containing not more than 3 dwelling units. So if you buy a giant, pie in the sky, multi-level apartment building, you are still allowed to do that. It can be part of a building, a condo, a townhouse row, or anything else. All of that is subject to the PPRP. Or it is also vacant land upon which a habitable dwelling can be built or a mixed-use dwelling can be built. So the PPRP extends to all of that, but it only extends to certain areas. Now, typical of the Canadian government, they chose to use a definition that none of us are actually familiar with, that comes from Statistics Canada alone. And they say that the PPRP applies only to CMAs, census metropolitan areas, which practically for all intents and purposes include every single area of the country that we care about. Every major city is contained. And, I highlighted the area of Ontario, and you can see that almost everything is included in it. Sudbury, Timmins is also included. Really, unless you're buying in farmland or Northern Ontario, the PPRP is applicable. Having said that, if you're buying outside of a major city center, it's possible that you're exempt from the PPRP because it does not apply to all of Canada. It only applies to a census metropolitan area, which PS allows, because of the definition of residential property, for Chinese buyers to continue to buy up our mineral rights. Nothing is stopping people from making massive investments in our in the only thing that makes Canada money outside of real estate, which is our raw materials, right? Because it only restricts residential property purchase. And, the oil gas fields are not residential, nor are the mineral rights. And what's more, those places are not actually contained in CMAs, right? I'm going to pause. Anyone have any questions about non-Canadians purchasing or residential property so far? We cool? We cool. Okay, let's keep going. So, sorry, just 1 second, guys. Just bear with me for 1 more second, sorry. All right. So we're now on point 4, the exemptions. So the prohibition, the PPRP comes into force. The act prohibits non-Canadians, which we now understand, from purchasing, which we now understand, residential property, which we now understand, for a period of 2 years. Don't need to explain that, you understand that, with some exceptions. What are the exceptions? Well, the first exception are international students. But quite frankly, the way it's drafted, there's no way that this is going to be applicable to all but exactly 3 people maybe in history. And the reason is because in order to qualify as an international student, you A, have to be purchasing your first property. You B, have to be purchasing a property that's under $500,000 in value. PS, good luck with that in the GTA. You 3, have to be purchasing and you have to have actually had income tax returns for 5 preceding years. Now, the problem with international students is that they are usually here on less than 5 years. And by the way, if they are here, they may not be filing tax returns, which is very, very, very common. So to have a student, an international student that is here for 5 years, that is finding a property for less than $500,000, that hasn't purchased a property, and that has been here for 244 days in each of 5 calendar years preceding, is like so restrictive that this exemption will hardly ever be used. So yes, there's a restriction for students, but given all of the restrictions that exist for international students, it's not bloody likely that you will be able to make use of this exemption very well. This is different than the second exemption, which is the work permit holder exemption. The work permit holders are exempt if they worked full-time for a period of 3 years. Full-time is defined in the Income Tax Act. I forget what it is, but it's qualified by the amount of hours you work per year, and I forget what it is. If they filed their income taxes, regardless of what they earned for 3 or 4 years, and they haven't purchased property, okay, that's very doable. That actually work permits seem to be exempt from the PPRP largely. International students, good luck to you. You're never going to find anything. I mean, don't get me wrong. You may find property under $500,000 because this is a Canada-wide, restriction. So, Saskatchewan, Saskatoon, whatever, or even Booneville, Ontario, you're fine. But good luck to you on the 5 taxation years, and good luck to you on the 5 years of 244. It's just not going to happen. Whereas the work permit exemption is real. Similarly, if you're a spouse of a qualified person, meaning a Canadian citizen or a permanent resident, you qualify. And then diplomats and refugees and everything else, there are certain exemptions. What's interesting is that particularly for work permit holders, the fact that you are exempt from the PPRP does not mean that you're exempt from the NRST. So you may still have to pay 25% premium whilst being allowed to buy property. And in order to do that, we have to turn our attention to the NRST, which we're going to do very shortly. I just want to finish up on the PPRP. So let's finish up the PPRP here. We're at the penalty. What are the consequences? So first off, I want to tell you that the consequences that the Canadian government made are laughable. Almost non-existent. So in the event that you buy a property and you're not a resident of Canada, then you're subject to a $10,000 fine. Also, technically, a court may be able to reverse the purchase. It never will, but that's allowed. Of greater consequence is the fact that I, as a lawyer, you as agents or lawyers, are held to professional standards. And from our perspective, as this is the law, separate and apart from the $10,000 fine, we cannot knowingly abet people who are disregarding the law. Professionals are governed by codes of ethics and are required to adhere to the terms of the law. And thus, you cannot knowingly help people evade the law. Now, if they do so, if they lie, they'll face a $10,000 fine, a slap on the wrist, and nothing. But as professionals, we have to be vigilant and actually enforce this because that's our job. And those are our code of ethics. I'd point out to you that there are greater effects than just $10,000. I was actually in Shanghai at a property show selling. I did a lot of money movement from China into Canada for some years. And I was at Shanghai and I was doing a thing. And there was like all the jurisdictions that wanted Chinese money back in 2016 before she changed the law and basically the Canadian currency basket was no longer seen as a good thing. While it was seen as a good thing, there was money flowing into Canada massively from China. And we were there, and Canada had more booths than anyone else, more than the States, more than anything. It was ridiculous. But we dwarfed Australia and New Zealand, which, by the way, the previous year had quite the group of people attending. And the reason we dwarfed them is because Australia and New Zealand brought in similar legislation to this, prohibiting people from purchasing. And even though there were still slap on the wrist regulations in Australia and New Zealand, should they purchase, the very fact that the law existed precluded people from investing there and substantially lessened the amount of money that actually flowed into the country at these types of shows. So I suspect that it will have some effect, even though their penalty is just laughable and there's not really much other than our professional obligations to ensure that the law is adhered to. I'm going to pause for a minute. Any questions about the PPRP before I move on to the NRST?
Does this apply for pre-construction as well? I know it's a foolish question, but there are some pre-construction that are under 500.
Yes, it applies for pre-construction, though if you've signed a pre-construction agreement before the act came into force, you are grandfathered.
Thank you.
Okay.
Just a question, do any of the professionals get fined?
Well, your professions, so first of all, yes, you can actually, as a professional, if you do not make reasonable inquiries under the act, you can be fined. But more importantly, you can also be fined by our governing bodies for failure to abide by basic competence standards. So there's two different consequences. One, you are directly liable if you don't make requisite inquiries of your client, which, by the way, is in a lot of legislation, but is in this legislation. But two, there's the actual enforcement of competence and to act in good faith and a whole bunch of other things that exist in the code of ethics and exist in the solicitor codes and everything else to fundamentally do this as well. And you can be brought up on charges for failure to actually make reasonable inquiry on that basis as well. So there's two distinct sources of having to actually abide by your professional obligations. Make sense? Okay. Let's keep going. I'm just going to quickly go through some questions and then we're going to move on to the NRST. We'll be done in an hour. If a client is unsure if they qualify to buy under the law, what should they do? Well, that was asked to me directly, but still, simply consult with a lawyer, get it in writing, and you're done. Marion asks, "Hi Moshe, I have a question. If my Canadian PR friends had funds transferred from non-Canadian parents, can my clients purchase with funds from non-residents?" Absolutely, Marion. They can purchase with funds from non-residents so long as they're not purchasing for non-residents. So to be clear, they can use non-resident money. There's no problem with gifting money to a Canadian. No problem at all. So long as the Canadian is the one who is actually then taking legal or equitable title. They cannot be putting it in their name for the purposes of the parents who have funded this. The money has to be a gift. The gift can then be used. Does that make sense? I assume it does. I mean, it's not that complex. And Pavel writes, "Can a foreign buyer enter into a pre-construction agreement with a closing date that is 3 years from now?" You can, Pavel, but it's not smart because who knows what the law will be in 3 years. I mean, I tend to think that this entire law will fall by the wayside within 2 years. Regardless, but who knows? It's not smart. Or you can do what I did for a client recently for new construction. We have a clause in the new construction which the builder agreed to that said that if there is a restriction on foreign ownership at the time of conveyance, then the builder shall permit this agreement to dissipate and the deposit shall be returned in full and without deduction. And they agreed to it, they understood it, and putting that clause in protected the clients and allowed people to go ahead and make purchases now. Does that make sense? Builders are ready to work with that type of clause. Okay, so we have done the PPRP. Let's talk about the NRST. Again, the NRST is predicated upon actual citizenship or PR status. Has nothing to do with your tax citizenship. If you hold a passport, you're good. So what's the NRST? The NRST is a 25% tax premium levied on the purchase of property if any purchasing part of that property is a non-resident of Canada, if the conveyance of the agreement of purchase and sale stems after October 25th. Now, if it's before October 25th, it was 20%, and then before that it was 15%. And so, you know, there are certain dates that go, but after October 25th, everyone has to pay 25% for units that contain less than 6 residential units. Doesn't apply to commercial, industrial, or agricultural land, and it applies now to all of Canada. Sorry, all of Ontario, my apologies. So who's exempt from paying the NRST? Canadian citizens, again, citizens, passport. Permanent residents, foreign nationals operating under the Ontario Immigrant Nominee Program who have applied to become a PR before the expiration of their certificate. So that's a pretty specific thing. You have to make sure that not only are they under the Ontario Immigrant Nominee Program, but they have applied to become a PR. Refugees or spouses. In addition, anyone is allowed to pay the NRST, the extra 25%, and so long as they become a PR within 4 years of having closed their property and apply within 90 days of having become a PR, they can get back the NRST. So those are the people who are broadly exempt or who get a rebate for it back. There's a couple of other exceptions, but that's what it is. Similar to the PPRP, if you hold land beneficially in trust for a non-resident, it's payable. This is the wrong question. It should be, is land transfer tax payable on top of the NRST? It's not. Not the, I wrote that the wrong way, I'm sorry. And tax is only payable on the residential portion of a mixed-use property. So we're all pretty familiar with the NRST at this point. I suspect that you guys don't have questions, but I'm going to open it up before I move to withholding tax, which you guys are less familiar with, even though it's been around for the longest period of time. Any questions so far on NRST or PPRP?
Just clarifying, the NRST tax is payable plus land transfer tax is payable.
Yes, but land transfer tax is not payable on the NRST portion.
Right. Okay.
Correct.
That was the confusing point.
Yeah, sorry, I didn't write the question properly. This is a silly question, the way I wrote it. I apologize. Okay, so let's talk about withholding tax. So far, we've talked about the restrictions and the taxes payable at the time of purchase. Less people think about the taxes that are payable by foreign residents at the time of sale. The withholding tax is that tax. Now, to be clear, the withholding tax is payable whenever a non-resident sells anything. So, you know, when you meet that person at the Shoppers Drug Mart parking lot and buy a PS5 from them in the dead of night, technically, A, you're supposed to pay HST on that. Haha. But you're supposed to. 2, you're supposed to ask and receive the statutory declaration from them stating that they are not a non-resident of Canada for tax purposes. And if they are, you're supposed to withhold 25%, technically. I mean, good luck getting your PS5 at 12 o'clock at night in the Shoppers Drug Mart parking lot. You're not going to do it, but that doesn't mean that that's not the law. That is the law. In the same way that paying HST is the law. So let's talk about this. Every real estate transaction, the seller must be a resident of Canada for tax purposes. So unlike the PPRP and the NRST, which require a passport in this instance is not good enough. You must be paying Canadian taxes. You must be a resident of Canada for tax purposes. You can ask your accountant if you are, but effectively, if you pay Canadian taxes, and if you've lived in Canada for 183 days of the year, you are paying your Canadian taxes, and you are a Canadian resident. But what if you are not? Well, under section 17 of the OREA Form 100, it says exactly what happens. Now, by the way, even if you cross this off, this is still the law. It doesn't matter if it's contained in the OREA 100 or not. This is the law. What the law says in English is that if you're a non-resident of Canada, you must do one of 3 things. You must either pay your taxes to the government in advance and get a clearance certificate. You must provide the buyer with a statutory declaration stating that you are a resident of Canada for tax purposes, or the buyer must withhold 25% of the overall purchase price and remit that to the government. So why 25%? So let's go over this. By the way, it's 25% of residential, 50% of commercial. So why 25%? So let's take the scenario that I have, okay? A normal residential sale. So this is if there's someone who's a resident of Canada. So a property is purchased for $100,000. Haha, good luck with that, but still. Property sold for $250,000. Oops, that's not right. Sorry, property sold for $250,000. The gain is therefore $150,000. And the capital gain, because you pay a capital gain on this, is going to be $75,000. You take 50% of that. And the tax payable at the highest tax bracket on that scenario is $40,500. Now, if you are a normal Canadian citizen, when you sell your property, you're going to file taxes at the end of the year, and you're going to have to pay this $40,500. That's part and parcel of what your obligation is. No problem. But what if you're an emir or a sheik in the Arab Emirates. There was actually a famous case out in Oakville where a home was sold for like $40 million and it was owned by an Arab sheik. And they said, I'm not a resident of Canada. I'm not giving you a statutory declaration. And they transferred 100% of the purchase price. Well, let's take a look. So again, same scenario. The actual amount owing is $40,500 as before. But in this instance, because the government is giving, because you're giving 25% of the purchase price, which is 25% of $250,000, the government is collecting $62,500 from the buyer. And as a result, the emir or whoever it is that has no incentive to deal with the Canadian government suddenly has an incentive to deal with the Canadian government, because when they file taxes, they're going to get back $22,000 from the government. Right? When they file taxes, the government's going to say, oops, we have $62,500 of yours, and you only owe us $40,500. So here, we're going to give you back your $22,000. And so in collecting this money up front from non-residents through the buyer, what the government is doing is ensuring that its taxes get paid. In the instance of that Oakville home, the government was allowed to go after the buyer for the 25%. The buyer then sued the lawyer. The lawyer only had $2 million worth of insurance. There was more than $2 million owing, and the buyer got screwed. Make sense? So one of three things needs to happen. The buyer can withhold the 25% and turn it over to the CRA, as we described. The buyer can prepay the tax owing if they're a non-resident and get a clearance certificate from the government, provide it to the seller, and then that way the seller can provide 100%. So they can pay the $500 in advance, and an accountant can help you with that. Or the seller can provide a statutory declaration stating that they are residents of Canada for tax purposes. And that's it. I mean, what I said here is note that it doesn't matter if the seller is telling the truth. The CRA does not hold the buyer responsible if the seller is being misleading, so long as the buyer is not aware that the seller is being misleading or is being willfully blind to the situation. So you're allowed to rely on a seller's statutory declaration unless there's obvious reasons not to do so. You make your inquiry, you say, are you there? The lawyer on the other side says, yes, we're no problem. And then you say, okay, thank you very much. But if the documentation is coming signed by a notary public in Indonesia, and they're not around, and you may want to make further inquiries, because it would be reasonable to say, wait, hold on, are they actually resident of Canada? And that's the obligation a professional has, just make reasonable inquiries. So that is that. Those are the three things you need to know about being a foreign buyer. You need to understand that the PPRP may be applicable based on the definitions we talked about. You need to understand that the NRST may be payable of 25%, and you need to understand that when they sell, they don't need to pay extra tax, but they pay tax differently and upfront. It's critical that you understand that, by the way, when you're acting for a seller, because in the event that a seller goes ahead and sells a property and the buyer withholds 25% and the mortgage is for 80% of the purchase price, well, you don't have enough money to pay off the mortgage. You can't get clean title because you've taken 25% remitted it to the CRA, and you need 80% in order to pay off the mortgage. There isn't sufficient money. So it's really important that you, as sellers who are dealing with non-residents, understand this point before they engage in the sale so as not to have any problems. Okay. That brings me to the end of today. Any questions? I expected that this one would be a bit shorter, and it is, but I think we covered our ground. Who has what question? Go ahead, feel free. We have till 11 o'clock, so I'm here.
Hi, Mark.
Yep.
Quick question. If a seller currently reside out of the country, but they have been paying tax consecutively for the past 5 years, are they still considered non-residents of Canada under the
Income Tax Act?
Yes.
Excellent question, and here's how you're going to answer it. This is literally what I do, and this is what I'm going to suggest you do. Be advised that if you're a non-resident of Canada, hello X, be advised that if you're a non-resident of Canada, certain withholding taxes may apply. It is vital that we hear from your accountant as to whether you're a resident of Canada for tax purposes. Please ask your accountant and get back to me with their response. That's it. You don't need to think about this at all. All you need to do is ask them to ask their accountant, because the requisite professional who is in charge of this and who could determine if in fact they've sojourned and if they paid their taxes and everything else is their accountant. Put it on their accountant, ask that question. That's what I do as a lawyer too. My reasonable inquiry is not actually asking them a bunch of questions or anything else. I say, who's your accountant? Let me email them and I say, is this person a non-resident of Canada for 116 compliance? And that CA writes me back and says yes or no, and I have done my due diligence relying on another professional. Make sense?
Thank you. Yes, it does. Thank you.
Okay. Don't involve yourself in trying to figure it out. All right, next question. Anything else? 76 wonderful learning faces. Come on, someone has a question.
Peter C., who is a lawyer in the group who was talking about this last week, said that if we have any concerns about whether a buyer meets the requirements or not, or whether they meet the requirements for the exemptions, he's quite willing to put it in writing for realtors so that they can go ahead. If there's any other lawyers, if there are any other lawyers in this group that are willing to take that on, I think we should add that to our list of lawyers, because it's going to become very, very important so that we don't have to determine it. We have some professional doing it.
Perfect. Okay, thank you, Sandra. Okay, I'm going to read a couple of questions that have been asked to me. Guys, when you're asking questions, can you make sure that you don't direct message me? Just write the whole group. But if a client is unsure if they qualify to buy under this law, what should they do? And how do they define rental? So, well, if you're unsure, speak to a lawyer, as Sandra just mentioned, and they'll put it in writing for you. And then you can rely on that because it's a professional that can actually speak to it. You know, there's a lot of lawyers in this group that would be happy to discuss this with you because it's future business. How do they define rental? A rental is a rental property. It's one where you're not taking legal ownership on the land registry. It's just a rental agreement. Simple. I have a question. If my PR had funds transfer, oh, sorry, I've answered Marion's. Pavel's I've answered. Can you clarify the refugee ones? If the refugee claimant can buy the property and has to pay the NRST. I've never dealt with a refugee, but my understanding is that refugees who have gone through the right process are exempt. They are exempt. So I could go look into it for further details. I'm sure that there's a criteria and a checklist, and you probably have to qualify as a specific type of refugee, but they are exempt under the law. Okay, those are the questions so far. Any other questions for me?
Hi, Mark. My name is Shola.
Hi, Sola.
I just wanted to speak regarding the refugee that you just mentioned, because I just completed a deal early this year. I can tell you that if the refugee claimant hasn't gotten the final decision from immigration, they would have to pay the non-resident tax. If, however, they have the final decision from immigration stating that they are confirmed refugees, then they don't have to pay.
And I would suspect, Sola, without having again investigated the refugee portion of this, because I've never dealt with it in my office, that if in fact it is payable and you later become a refugee, you get the refunded anyways. My guess is that there's some sort of exemption for that as well.
Yeah, you're very correct. They get the funds back once they are able to get their refugee the status or become a permanent resident.
Right. That's what or once they become an official refugee. I'll look it up. But again, this isn't an area that I've ever dealt with in my professional career. I just am tangentially aware of the law. So thank you for that color. Okay. Andrea,
my understanding is same, Mark. My understanding is same, Mark, because we have two different definition about the refugee. One is the one who just exempt from, has just relief to have the claim at the refugee division, and the one that got the decision. So I think section 95, which is in NRST, refer to the one who got the decision, but the one in PPRA, the new prohibition rules, refer to the one who still didn't get the decision. So my understanding is that those refugees who just have the claim can still buy the house, but they are not exempt from NRST until they get the decision regarding the PR. This is my understanding. I'm not
very possible. Again, guys, you either have to go to a lawyer who's ready to spend the time researching this or who knows this based on having dealt with it. I have neither researched this nor dealt with this particular scenario. I haven't dealt with refugee claims for NRST or PPRP. So with your permission, I'm just taking what you're saying as sure, but make sure that you discuss this with your requisite professionals. Obviously, that's important to get down to the bottom and get it in writing from them. But thank you again for the color from both of you. All right, if the property is sold firm and seller would like to leave Canada before closing, does the 25% tax need to be withheld? Andrea, so long as they are a resident of Canada in that existing taxation year, then no. And again, it's a question of whether at the time that they are conveying the property, they are a resident of Canada, and the accountant is the only person who can answer that. But usually the answer is no. If they're selling to leave, they're usually not, they usually are residents of Canada. Danny, I see your hand up. I'm just going to read one more and then we'll come to you, okay? Lisa writes, my apologies if I missed this exemption. Is there also an exemption where the intention is to rent the property? No. People are getting a bit confused by that. There's no exemption if you're planning on renting the property. There is an exemption for rentals. So the definition of purchase does not include a rental activity. But if you're buying a property for the purposes of renting, no, that is captured by the PPRP. I imagine that mobile home on leased land does not qualify as real estate. I would agree with you, Lisa. I think that's an accurate assessment. I'd have to look it up, but that would be my predisposition as well. Dania, please go ahead.
Hi, thanks, Mark, for holding this. This is very informative. I wanted to just have some clarification around the international students and that kind of stuff. So my whole practice has been niched around, I'm in London. So, you know, international students coming here with the intent of having to get their permanent residency. Some have one spouse that might have a work permit, others that, you know, they're working remotely, but their intent is, my question is, once they've been here, we found them a lease property, they've been here, when will they be able to qualify to purchase? Are they going to have to wait that 3 to 5 years based on that criteria of the tax refunds that you were talking about?
Based on the tax refunds.
Like, well, sorry, the filing of taxes, sorry, not refunds, but the filing of the taxes.
Yeah, look, it doesn't, if they're a spouse of a Canadian or a PR, no problem. But as I was saying, they have to be here for 5 years for 244 days. They have to have filed taxes for 5 years or whatever it is. Like, no, you work with students. Outside of your PhD student who's been a perpetual student for 10 years, every person who comes to you is there in year 2 or 3 of an undergrad. That's who you mean by a student, right? None of them are fitting this definition. They just aren't based on the timelines that are there. And as a result, no, they'll probably have to wait the 2 years for this law to die, which I suspect it will, because its relevance has largely stopped being useful, or alternatively, a regulation needs to change to allow for greater leeway for international students. But no, it is designed around students who are doing more than 1 degree. You have to have been a student for more than just an undergrad in order to even qualify based on the timelines. It's just pointless.
Yeah, it really does. It impacts a lot of people in my situation, say in a university city, right? Where people are coming with the intent of landing here and making a life here in Canada, so.
Right. Well, I mean, realistically, what this is going to do is it's going to throw the investment class, that is to say, the people who are sending their kids to Canada and have assets, into true investments. So what we're doing is we're going to push them into multi-res investments. Okay, kid, buy a 10-plex. Look, be exempt, buy a 10-plex. They're better returns anyways. And then you could live there and you could, and that's what's happening. We're just going to dictate that the money flow go elsewhere. This is a stupid law, but it's a law and we all have to abide by it. Cameron.
You just hit it. I was going to ask you about the multiple plex buildings. So they can still purchase them like a 3+?
Yes, they can purchase it. Remember, the 3-plex is the PPRP, the 6-plex is the NRST. And so the most desirable income property that will exist in student-based properties like London is going to be the 7-plex or more.
Yeah, that's what I was thinking for Diana. One clarification about New Zealand you brought up earlier. I'm not sure if you've heard that yesterday the Prime Minister of New Zealand stepped down.
I did.
Do you think that's going to happen to Justin Trudeau? Hopefully.
I have no idea, and it's beyond the board. We're not going to discuss politics here. We're only going to discuss law. That's what we do.
I'm kidding. Okay.
All right. What else? What else, guys? Anything else? All right. 10:52, guys, I'll post this. Thank you everyone who attended. Kudos on you. I know this is, as I said, a bit of a drier subject, but it's a really important subject, particularly the withholding tax and the NRST. Those things aren't going anywhere. The Canadian government legislation, I expect we'll see the last of it in 2 years. But the other stuff is all very important, especially the withholding tax, particularly if you do sales for non-residents. So I'm glad you were here. Thank you for your attendance. Thank you everyone who attended, and I'll post this shortly on our forum. Everyone, I wish you a wonderful day.
Thank you, Mark.